Welcome to Level 2, Lesson 4. My name is RIA the Trader from TradingWing.net. This lesson will be a little bit more complex than previous lessons. Please try your best to pay attention and take as many notes as possible. If you are stuck on any of the topics mentioned, please note that I will further elaborate on them in a later lesson. In this lesson, you will learn about the difference between stock commons and stock options. So let's get started. What exactly are stock commons? As we have mentioned in previous lessons, stock commons, better known as commons, are an ownership share in a company. So when you buy stock shares, you are essentially purchasing part of the company. Stock commons do at times have some added benefit, such as dividends, another thing we have mentioned in a previous lesson. Here are some important commons terminology you will need to know before you start trading or investing. Bid is the highest price someone is willing to pay to buy the stock. This is similar to bidding on eBay or in the housing market. Ask is the lowest price someone is willing to accept to sell the stock. This is again similar to the ask price in the housing market. So what are some critical aspects of commons? Commons are typically less risky. Unless a company goes bankrupt and or delists from the stock exchange, you typically cannot lose your whole investment. So if you were to buy a stock for $10 per share and the price moved down to $3 per share, you can still secure the $3 per share, as we are not expecting the price of the commons to become zero. Commons are also easier to manage, which means at times they're hands-off with low expenses. And finally, commons are extremely simple. You typically buy a stock following due diligence and look to sell at a higher price any point down the road, whether that be 1 year, 2 years, 5 years, 10 years, or 20 years. You get the idea. Now let's talk about stock options. This is where things get a little bit more tricky, so bear with me. Stock options, better known as options, are an ownership of the right to buy or sell shares of commons for a set price, known as the strike price, at a future date or before expiry. Keep in mind, there is no ownership of the company involved with options. There are also no added benefits to options such as dividends. One important thing to note when looking at options is that one contract is equivalent to 100 common shares. This is not related to the common's price, but rather the number of shares. Some important options terminology that you need to make note of are the following. Calls are options you purchase if you expect the common's price to rise within a certain time frame. Puts are options you purchase if you expect the common's price to drop within a certain time frame. Strike price is the set, agreed-on price at which an option holder can buy or sell the commons of that company. Expiry is the day an option contract expires and or becomes rendered useless. Premium is the price you will pay to buy an option contract. And finally, execute or execution will convert your option contracts into 100 common shares per contract. For example, if you are holding 2 contracts and you executed your options contracts, you would then be holding 200 common shares. Let's look at an example of an option. Let's say we are looking at the company Tesla, ticker symbol TSLA, and the current commons price is $1,000 per share. If I, for whatever reason, believe the price will move up to 1,100 per share by next week, I will play an options call. I will set my strike price to $1,000 because that's where I would like to secure my price. my expiry would be next week or the following week, as I am expecting the price to move up by then. Let's say, for example, the premium is $3 per contract. Because one contract is equivalent to 100 common shares, my premium paid is actually $300 per contract, as we are taking the $3 per contract premium and multiplying it by 100 commons. Once we have bought that call option, we now have two choices. My first choice is to sell my options contract to someone else for profit. If I bought the option for $300 and I sell it for $1,800, I am now taking $1,500 profit. My second choice is as follows. The price of Tesla commons went to $1,250, and I chose to execute my option because it has not expired yet. My initial $300 premium would now be gone. However, I would execute at my secured price of $1,000 per share, despite the price of Tesla being at $1,250. To put it into better terms, I used $300 to secure my spot at $1,000 per share. Once I execute, I am now obligated to purchase 100 shares of Tesla at $1,000 per share. Therefore, I am spending $100,000. I would then have the ability to sell those 100 commons for $1,250 a share, as that is the current price. Therefore, my profit would be $25,000. Now, what are some critical aspects of options? With any trading, there is high risk, high reward. So yes, options can be very rewarding if done correctly. Options can see anywhere from 100 to 10,000% return in a matter of minutes or days. Options are, however, high risk, which means you can easily lose your whole investment. Options are also difficult to manage. You must be hands-on and be aware that options come with higher expenses. Options are also extremely complex in comparison to commons. An options trader must take into account Greek symbols such as theta, gamma, delta, and so on. They must also take into account implied volatility, known as IV, and must also take into account the commons price. All of these factors contribute to the change in options premium. If you are a beginner to trading, here is what I recommend you do. Focus on stock commons for at least 12 to 24 months. Take that time to experience corrections, market manipulations, and so on. Take that time to also learn how the overall market works with regard to risk, technical analysis, fundamental analysis, and so on. During that 12 to 24 month period, you can still learn the basics of options during your free time, but do not act on them. Once you are ready to start options trading, do not purchase a large sum of contracts. Start small. In fact, I would recommend you start with one option. Do not blindly follow others. That means do your own research and due diligence, as other people's opinions can often vary. And finally, practice the strategies you learned and keep the ones that work. The strategies that do not work, move on from. And that concludes this lesson.